Making that first investment into the stock market can seem very daunting, whether that be because you don't know how to invest or you are in fear of losing your hard-earned money. After all, it's in our nature to be risk-averse, and the thought of losing our money often terrifies us.
At some point, you're going to have to make that first investment or risk living a mediocre life, spending what seems to be all of your available time working for money. We wouldn't want that for us, and we don't want it for you. If you don't allow money to work for you, then you will work for money every day until you are dead.
In this video, we're going to look at how I started investing in the stock market from my very first investment and why I made that investment. We'll even look at some of the mistakes I made and some of the things I got right. Let's check it out.
Welcome to Money Unshackled, the investment channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we have to say, click the like button and hit subscribe.
There's also a ton of investment articles on the Money Unshackled website that you can read while you're bored at work. The link is in the description below. Let's get into the video. Some of the details are a little hazy because it was about 14 years ago, and in hindsight, I didn't even really know what investment I was buying into. I can't even remember the circumstances of why I was looking to invest, but somehow I came across this investment that my building society was offering that offered a minimum return, a minimum guaranteed return, and potentially unlimited upside.
Bear in mind that any investment that offers a guaranteed minimum return should be treated with care. The provider of such an investment must be taking on considerable risk, and in return they will expect to make decent profits for themselves. In some way, you will be paying for this.
Also, you should never go directly to your bank or building society for any product without checking the market first. Loyalty always costs money. You thought you were talking to a financial advisor, but in fact you were talking to a salesman. It is very unlikely that the bank that you have a current account with will also happen to have the best savings accounts, the best mortgages, the best investments. It pays to shop around.
Note that neither of us hold our investments through banks, rather we use online trading platforms as the fees are significantly reduced and you have access to the entire world market. This particular investment would lock your money away for 4 long years, and in return you would get half the return of the FTSE 100 or 3% per year, whichever was greater. A guaranteed 3% today might sound good, but bear in mind that back in 2006, banks were offering interest rates of 5 or 6% plus without restrictions on your money.
At the time, getting half the return of the FTSE 100 seemed like a fair trade in exchange for the 3% guaranteed return should the FTSE fail. However, it dawned on me later that I wasn't just sacrificing half the FTSE return, I was also surrendering any rights to those dividends. I wouldn't have known this at the time, but the dividend yield on the FTSE 100 is often way in excess of 4% alone.
What was this product? The investment product is something that we know today as a structured product or a defined return. And taking the definition from Investopedia,
structured products are designed to facilitate highly customized risk-return objectives. This is accomplished by taking a traditional security such as a conventional investment-grade bond and replacing the usual payment features, e.g. periodic coupons and final principal, with non-traditional payoffs derived not from the issuer's own cash flow, but from the performance of one or more underlying assets.
Clear as mud? Didn't think so. Essentially, these are pre-packaged products that use complex derivatives. We only understand the basics now, so I clearly had little understanding of what I was investing in 14 years ago. What's worse, the company behind this particular investment, Key Data Investment Services, went into administration in 2009. I bought the investment through my building society, but they were essentially only working as an intermediary. What good is a guarantee if the counterparty cannot honour it?
What was the outcome? Long story short, the FTSE had tanked by the time Andy's maturity date rolled around, but he did get the 3% guaranteed income per year. However, in this case it would have worked out better had he just put his money in a high interest savings account which were being offered at the time. The moral of the story is, make sure that you know what you're investing in, and especially that you understand the risk. And never forget that there usually is an opportunity cost.
What I did right. It sounds like this was mostly a bad experience, but there are many positives that can be taken away from it. Firstly, it was my first foray into investing, and who knows where I would be today without it.
What Andy did was learning by doing, and this experience in itself is invaluable.
Today we have both built up sizable investment portfolios that pay us each an income, which forms part of our freedom funds. My investment part is the foundation of my early retirement plans, perhaps by my mid-30s. I also learned a lot about the FTSE 100, and I suppose it was partly because of this that I started to monitor the investment markets and learn about money.
What happened next? At the age of 22, a little older and wiser Andy would go on to buy his first ETF and would rapidly start building his investment portfolio. This time the strategy was dividends. While we're on the subject of first investments, we'll soon be releasing a video on how I got started with my first ever property investment. So make sure that you click the subscribe button and the bell so you don't miss it.
Armed with a little more knowledge, my first proper investment was the iShares FTSE 100 ETF, and I've owned it ever since, and I've even added more to my position. I quickly followed this with a purchase of the iShares FTSE 250 ETF. Even to this day, I remember my goal was to build a huge diversified portfolio as cheaply as possible. Way back then, there was no such thing as a free investment platform.
Today, we all have the luxury of being able to invest in the stock market for free or almost free using very popular platforms such as Trading 212 and Free Trade. We have a couple of review videos which we'll link to in the description below, so check these out. And we even have some fantastic offers available if you're interested, where you can get a free share worth up to £200 just for opening an account. It's free cash for nothing.
These investments are quickly followed by a string of individual stocks such as BP, Aviva and many more. These stocks, along with other purchases, added excitement to my portfolio, but perhaps with unnecessary risk. Despite us predominantly preaching about index tracking strategies, I certainly don't regret buying into these individual stocks because I made a lot of money. But the lessons learned is worth so much more. Much of this knowledge is what allows us to create these videos for you today.
Question of the day. What was your first investment and what did you learn from it? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.